And thanks for staying with us, everyone. Fitch Solutions is projecting a further monetary tightening by the Bank of Ghana next year. According to the UK-based research and market information firm, the policy rate will go up by a further 200 basis points, or 2% to 29%. This will trigger increase in the cost of credit and consequently heighten the cost of doing business in the country. Mike Kruniger is Senior Country Risk Analyst at Fitch Solutions and has been speaking about Ghana's economic outlook for next year.
We also note that the impact of significant monetary tightening in 2022 will restrict corporate and household access to credit and thus weigh on fixed investment and private consumption through 2023, further slowing economic growth. And this is reflected by the chart on the left-hand side, which shows the Bank of Ghana's aggressive monetary tightening cycle in 2022. We believe that this tightening cycle isn't over just yet, and that the central bank will hike by an additional 200 basis points to 29% by the end of 2023. Indeed, if we look at real interest rates, it becomes clear that the Bank of Ghana has a history of keeping those real interest rates in positive territory. So this informs our view that despite price growth reaching a disinflation path next year, the bank will keep raising rates in order to achieve those positive real interest rates in 2023, albeit at a slower pace compared to 2022.
Joining us, financial analyst Christian Tisi-Jan, to discuss this. Good afternoon to you. Happy holiday. The trend we have seen in the past few months is when inflation increases, the central bank tends to hike the policy rate. So this projection by Fitch Solutions certainly looks like something we should expect next year.
Yes, good afternoon, Daryl. Merry Christmas to you and the viewers. Yes, with Fitch reports, from every indication, BOG will be hiking the policy rate again in the coming days. And this is in its bid to tighten the monetary space, because it still wants to mop up excess liquidity in the system, because the inflation begins to continue to be up there. So in its bid to try to do that, definitely it wants to curtail inflation and also to discourage investors from changing their Ghana cedi into USD, just to ensure that the rates of the cedi is actually maintained. So we should actually expect these hikes. But what it also do is that normally when T-bills policy rates are high, it means treasury bills will also go up, and the banks sourcing deposits will become expensive, and therefore cost of borrowing to customers will also go high. And so once credit gets expensive, we all know what the repercussions are with a businessman being a rational economic agent. So with these hikes, we expect that cost of borrowing will become very expensive. And so far as the businessman is a rational economic agent, whatever cost that is coming in terms of the credits, it will be built on the final goods and services that are actually going to come onto the market. So we don't expect that inflation will actually go down any moment sooner, because what Bank of Ghana is trying to do is to measure or try to curtail the demand pull inflation. But so far as the policy rates also are high, it means the cost push will also go up. So it will come to a standstill. It's going to balance itself off. So let's hope and see what comes up in the coming days, if indeed is a 200 basis points that's actually going to be increased.
Well, there are some analysts who are opposed to this consistent increase in the policy rate, making the point that the inflation we are experiencing is imported, but the central bank seems to think this is the right approach.
Exactly, Daryl. I think I've made this point on this same platform before. And what we are experiencing is actually the cost push. And so, like I've explained earlier, so far as cost of borrowing goes high, the cost generally becomes very expensive. And you and I, being the final consumers, are the ones that are going to suffer the repercussions. And therefore, we expect that goods and services are going to be very expensive. In Bank of Ghana hiking the rates, for me, the target is not just about inflation. It is also to discourage investors from changing their Ghana cedi into USD, because there are better options. Instead of storing the value of the currency in USD to maintain its value, then they would rather want to churn or to have better returns, because now T-bills are doing about 36%. So once the policy rates get high, definitely the possibility of these rates getting higher, it's going to be high. So people will want to rather invest in the treasury bills instead of buying USD in maintaining the value of their currency. So maybe the target is really not with inflation, but to also help with the forex, which has seen a bit of stability in the last couple of weeks.
Yeah, well, speak of the forex, the cedi has made some gains against the dollar, other major trading currencies. So we expect the rate of inflation to slow. So do you expect that there's a change in approach by the central bank in tightening monetary policy? At what point, my question, do you think that the central bank would consider that?
Yes, for next month, we should expect inflation to peak if it's not going to start the decline period. And once that one comes, in the causes of inflation, we have the demand pull and we have the cost push. And so the cost push, because prices generally were very high, people use the USD, the very expensive USD to import into the country. At the end of the day, the cost of that product was going to get very high. But because the forex is actually coming down, the rate is coming down, it is going to slow down. It means that the cost of goods and services that were imported somewhere in December that were very expensive in January, because the rates are lower, we are going to see lower cost of generally goods and then services. So once that one comes up, then it will come and show up or make up for the demand pool that Bank of Ghana is trying to solve. So at the end of the day, we should see a bit of parity in the trend as we see with regards to the goods and services that are actually on the market.
Right. It's been a difficult year for businesses, and this policy rate hikes, they obviously impact on their ability to secure credit. So what solutions would you suggest for them to sustain their operations in 2023 if they are going to face difficulties in securing loans?
Yes, now with what is happening with the debt exchange program and all of that, liquidity is actually going to be stifled in the system as far as the banks are concerned. So this definitely is a very big discouragement to them. Some might not even be getting access to those credits. I'm suspecting that a lot of the banks will be doing the consumables and the fast-moving consumable products. So as much as possible, you should stay away from credit, because so far as the cost goes high, and then they being rational economic agents and trying to bill the final consumer with these costs, is going to get very, very interesting. So we are expecting that definitely people who are really, really not in dire need of credit support should stay away and try to turn around with their operational funds to ensure that there is a bit of stability in the business model that they are actually applying.
And how does this impact on the banking sector?
Yes, a lot, because if you look at what the government is trying to do with the debt exchange program, it actually anticipates that there's going to be liquidity challenges, and therefore it has set up that liquidity support of about 15 billion to help with the financial institutions. But for me, it's not going to be enough. It's also put up certain measures where the daily vault balances are actually reviewed here and there. The costs to all of these hikes are, sometimes it gets quite interesting, but definitely and generally, things are going to get very stiff for a lot of the universal banks in struggling for liquidity. So people, actually genuine people who are wanted to go for these credits, is going to be very difficult getting them.
Okay, my last question has to do with the outlook for the banking sector. You talk about the debt exchange program, which is already having a toll on investment and fund management firms. What do you think is likely to happen next year as far as the banking sector is concerned?
Yes, we've actually gone through a lot. Somewhere 2016, 2017, there was a cleanup where people lost utmost confidence in the banking sector. Over the period, there had been some confidence being built. And with the system that we are in Ghana, not many people are able to differentiate between the universal banks, the credit unions, the microfinance, the investment companies. And so they brought all of them into one basket. So far as one suffers, then it means the whole industry is going to suffer the repercussions. And so confidence within the banking sector, we should expect that it's really, really going to go down, and it will take so much more over the next 10 years to be able to repair these damages. Not just the local investors, I mean, our foreign investors are also going to be very much disappointed, and therefore, in the near future, should Ghana even float bonds on the international market, I don't think we're going to see the oversubscription that we used to experience, that sovereignty that Ghana used to enjoy. I don't think we are really going to see that enjoyment again.
That's great. Christian Tishijan, financial analyst, thank you so much for your time, and happy holidays once again. Now, prices of crude oil, shipping charges, the unstable exchange rate regime, among other factors this year, are said to have impacted negatively on businesses locally, with Gasem Limited being no exception. The cement producer, however, believes despite the impact on production and distribution, 2023 could paint a better picture for businesses. Commercial manager for Gasem Tema, Kwesi Chere, was speaking at the swearing-in of new executives of the Greater Accra Distributors Union for Gasem. Correspondent Kwame Yanka has more in the following report.
For Gasem Limited, 2022 could be largely described as a challenging year due to how external and internal factors negatively affected cement production and distribution. Representing management at the swearing-in of the new executives, commercial manager for Gasem Tema, Kwesi Chere, urged the distributors to stay committed to the Gasem brand. He is hopeful for the business year ahead.
Basically, from the international environment, it has been very, very challenging, as well as our local environment over here. I think we have all felt it this year, and I pray that next year bring joy to our distributors. Next year bring joy to the business that we are in, and next year bring joy to individual homes. It is because of our distributors, our cherished distributors, that we exist.
Chair of Gasem Distributors Union, Greater Accra Region, Issa Sai, who retained his seat, has identified a number of issues to tackle. These include reorganizing the distributors in the region, the need to sell at competitive prices, avoiding outrageous profits, among others.
If I say we have more to do, is the distributors in Greater Accra. We have a direct retailers and we have indirect retailers. And I have to tackle the direct retailers and talk to them, having meetings with them so that we can all sell at the local market equally, not to cripple some of the distributors. And we have to work and get profit so that we can pay our taxes as well.
Meanwhile, organizer for the union, Robert Annan, would want to see the city perform much better, as well as reduction in fuel prices.
The challenges we have is about the fuel and then the dollar. So Ghana is like, we are not using dollars here, but most of our big business people, they do use dollar to buy goods from outside. So because of that, it's like we have facing challenges on the dollar. It's like the dollar is going down, and I heard that it will go down more, and the fuel too, by the next year, 2023, it will come down more, because I heard the government now is going to change the fuel with a good, because we have a lot of good in the country. So it's like the government, he thinks that if we use the good to exchange the fuel, it will benefit us and to let the cost of the living in the country will be coming down.
The executive body will steer affairs of the distributors over the next 4 years.
All right, so it's been a tough year for industry, especially in the third quarter of this year, posting a growth of only 0.9%. But the agri sector performed well, contributing 4.7% to economic growth in the third quarter. Fishing contributed 10%, livestock 5.8%, forestry and logging 4.7%, crop and cocoa 4%. So what has changed over time? Joining us is Anthony Morrison, CEO of the Agribusiness Chamber. Compliments of the season, Anthony. What do you think contributed to this good performance by the agri sector in the third quarter of this year?
Thank you very much, and very well wishing to all your cherished viewers. Well, I think that we must commend the agribusiness sector, especially crop, our farmers, both livestock, crops, and fisheries. Largely, we know that we are in the festivity time, and we have more than 30 million people who are looking to have a very good family gathering. So most of this is being driven by the consumer, and we can attest for the fact that prices of rice have shot up. In some cases, we are having some challenges accessing most of the local food stuff. Just yesterday, we realized that the price of livestock have gone up, especially goods. People are buying goods around 800,000 to 1,004. We have also seen the same with fisheries as well. A lot of people are also moving from meat to fish. So these are major reasons. You know, the Christmas has become like a universal sort of thing for all religious bodies, whether Muslims, other religious bodies. Everybody is celebrating Christmas now. So it's no longer about Christians that are having a domain of Christmas festivities. And you know, the New Year is a New Year for everybody. So we have seen that majorly most of this is being driven by the festive time. A lot of people are organizing parties, a lot of people are organizing get-together, a lot of people are organizing several other programs just to make sure that they enjoy the facility. So consumables are key. We have also realized that the restaurants and the hotels have reduced quite a little bit because conferences are no longer in place. So you will see some measures of it. But it's good news for the industry. It's not to say that we are okay because our light harvest season is coming in, and we're going to see a lot of export as well. So there is still need for a lot of strategic investment to mitigate the incoming demand for export and also industrial use and domestic use.
Okay, I know you have been a critic of your Greek minister and some of his policies. Does he take credit for this?
Yes. For me and the industry, I think that sometimes it's good to place the praise where it is due and also to put in the blame where it should be placed. And the PFJ market for us has been a very disruptive one. Why are we not seeing this in other sectors of the sector? So across the country, why is it only being done in one city, Upreda and Accra? PFJ is the national staff, and we need to see across board. And you see, the simple reason here is that if PFJ pickup has been very successful, there is no need for the market, okay? Because market forces will push prices downward. If we have a lot of gluts in the system, you will see. But just as we have complained about the fact that a lot of interventions from the Ministry of Food and Agriculture have not really seen private sector or industry support. For instance, the ban on soya did not actually see all the support that we needed. And also, if you look at the challenges we are having with rice, it's also due to the fact that we have to be more intentional about the consumption rate, because we do have a deficit of $1.2 billion. That is, we have a national average consumption of 1.8 million metric tons. So these are some of the things that we need to be going against going into next year.
Okay.
A lot of investments are required, and we have the strategy to various interventions that we are bringing into the industry.
I mean, even though it's been a good third quarter, we still have a challenge with prices of food, which impacts on food security. And as we have been made to understand, it's not because we do not have food, but because we have challenges such as high cost of fuel, which affects transportation, and then translates in price hikes. How do you see this play out next year?
Well, we will continue to have this as far as we're having challenges with high input to production. For instance, most of the seeds we use are all imported into this country, and also the fertilizers, which are major components for crops. When it comes to livestock depend on crops, and they also depend on other derivatives of the feed components, like the feed additives of lysine, methionine, calcium, and all that. So these are very important areas. As far as the cost of farming an acre of rice, maize, soya continue to increase, you expect that the farmers will also increase their cost of production to be able to mitigate the investment that they are putting into it. So these are very important things that we need to look at. We need to look at the national kind of policy, what kind of mitigation point. For instance, government is talking about the economic enclave project. For me, we're having about 3 million farmers who are in need of serious support. So I don't believe in that kind of economic enclave project, okay? Because it is industrial driven. Now we are more talking about food security, where Ghana's food security index has reduced. We have seen in the budget some $400 and something million being made available for insurance. Meanwhile, the cost of the production or productivity in the agriculture sector continue to reduce. So why do you put money into insurance when we do not even have the food at all?
Okay.
So government, for me, have to set out their priorities right. We need to be engaging on global level as to what global trends are going and what we should do as a country to make sure that first we are food secure, two, we are able to drive the agro-industry export, and three, we are able to provide enough for our own industry. Because, for instance, if you take the 1D1F, why is it that the 1D1F is having a lot of challenges? It's because we do not have enough raw materials, okay? So all these are driven by productivity on the farm. If these raw materials are not available, recently we've seen the trade minister launching the youth in 1D1F. To what extent, or to what economic benefit would this be to the country when the raw materials are not available, when the skills of this youth are not what it takes to run factories? So, I mean, there are a lot of things that we need to be talking about as a country. And
we have just about a minute, and so I just want to bring in this question because we need to wrap up. You talk about sustainable measures. The Greek minister's idea to cut food to the ministries for sale is already losing steam. And so, of course, that is not sustainable going into the future. I don't know what the fourth quarter figures are going to look like, but just in a minute, if you can, what should we be looking at going into the next year to consolidate these gains that we have made?
Well, these gains are momentary because they are being driven by the Eurotank, the festival. What we need to do going to next season is, first of all, secure our seeds for both vegetables and cereals and grains. Where are our seeds coming from? As we speak now, the cost of seeds per acreage has gone up. Okay, if you are doing maize, you're going to spend, instead of 1,700 now, you spend like 2,000 plus. So a lot of things are going to work against us. But as usual, we need to hedge the input demand on the crop sector. On the livestock, which is the poultry, we are having immense challenges. These are another area where we need to look at, okay, how do we make serious investment into another sector? And it's good to see some private sector people coming in to provide some key interventions. But these are not sustainable. We need government to tune in some of their policies to support some of this engagement because these are very important.
Thank you.
We will see some major import or export of mango, cashew, and several others, which are going to bring in a lot of direct investment. But then we need to look at the maize, the rice, and other sectors.
We need to go, Anthony. Okay, we need to go. Unfortunately, we are running out of time, but I appreciate your insights and your input this afternoon. That's the Marketplace. Thanks for watching. My name is Daryl Kwawu. More news on our website, myjoyonline.com/business. We leave you with our Money Lab episode for today.
Hi there, and welcome to Money Lab. In our previous episode, we looked at inflation and how inflation can affect your investment. Today, we will learn about Ponzi schemes and why you must avoid them. Ponzi schemes are investment fraud that pays existing investors with funds collected from new investors. Ponzi schemes are named after Charles Ponzi. In the 1920s, Charles Ponzi promised investors a 50% return within a few months for what he claimed was an investment in international mail coupon. Now, does that modus operandi sound familiar? Ponzi schemes organizers promise a very high return with little or no risk. Instead, they use funds received from new participants to pay earlier participants. Before you participate in any investment scheme, ensure the scheme is registered with the Securities and Exchange Commission by checking on the Securities and Exchange Commission's website. Thank you for joining us on Money Lab today. See you again next time.